Every quarter for 15 years, the earnings met expectations. Every quarter, fabricated. 5 chief financial officers, all ordered to make the numbers up. All of them did it. $2.7 billion. The most institutionalized fraud in American corporate history. This is HealthSouth. Every quarter for nearly 15 years the earnings met expectations, and every quarter the stock analysts nodded and updated their models, and every quarter the share price held and rose, and Richard Scrushy, the founder and CEO of HealthSouth Corporation, was celebrated as one of the most effective healthcare executives in America, and the secret behind every single one of those quarterly earnings figures was that they had been fabricated, and the fabrication had been so systematic and so comprehensive that it had required the participation of every chief financial officer HealthSouth had ever employed, 5 of them in total, all of whom had been instructed by Scrushy to make the numbers say what they needed to say. And when the fraud finally unraveled in 2003, the gap between what HealthSouth had reported and what had actually happened was $2.7 billion, one of the largest accounting frauds in American history, and the story of how it was done is both more straightforward and more disturbing than most financial frauds because it required no sophisticated financial engineering. It required only a willingness to invent numbers and a CEO willing to order his finance department to do it. HealthSouth was founded in Birmingham, Alabama in 1984 by Richard Scrushy, and it grew to become the largest provider of rehabilitation healthcare services in the United States, operating hundreds of rehabilitation hospitals and outpatient rehabilitation centers across the country. And it served patients recovering from strokes and injuries and surgeries, and its facilities were genuinely useful, and the services it provided were genuinely needed, and Scrushy was genuinely talented at building and operating the business. The fraud began in 1996 when Scrushy instructed his finance team to begin manipulating the company's financial results to ensure that HealthSouth met the earnings per share targets that analysts had set for it, and the mechanism was simple and direct. If the actual earnings fell short of the target, and they regularly did, the difference was simply invented. Fictitious journal entries were made to revenue accounts, expenses were understated or deferred, and the accounts were adjusted until the reported figure matched the expectation, and the adjustments were tracked internally as the difference between real results and reported results, and this difference grew larger over the years, a few million in early years growing to hundreds of millions, until by 2002 the cumulative gap had reached $2.7 billion. The extraordinary feature of the HealthSouth fraud was the degree to which it was institutionalized across the finance function. Scrushy employed 5 different chief financial officers over the course of the fraud, and each one of them was brought into the scheme. Some willingly, some under pressure. And all of them participated, and the finance teams below the CFO level were also involved to varying degrees because the journal entries that created the fictitious earnings had to be made by someone and maintained and reconciled across multiple reporting periods, and the fact that the fraud persisted across multiple CFO transitions suggested either that there was something about the culture Scrushy had created that made participation feel inevitable, or that the pressure to participate was sufficient to overcome the ethical resistance of multiple successive financial executives. The investigation began in March 2003 when a former HealthSouth employee sent documents to the FBI suggesting that the company had been inflating earnings, and the FBI and SEC moved quickly, and in March 2003 the SEC filed civil charges against HealthSouth, and Scrushy was removed from his position as CEO, and the 5 former CFOs all pleaded guilty and became cooperating witnesses for the prosecution, and the evidence they provided was detailed and comprehensive. The criminal trial of Richard Scrushy, which concluded in June 2005, produced one of the most surprising verdicts in major corporate fraud cases, and despite the testimony of the 5 former CFOs, all of whom described Scrushy as the architect of the fraud, and despite other substantial evidence, Scrushy was acquitted on all 36 counts of fraud and related charges by a Birmingham, Alabama jury, and the acquittal was widely attributed to the fact that Scrushy had spent the period between his indictment and his trial cultivating his profile as a devout Christian in Birmingham's black community, attending church services, giving money to churches, appearing on gospel television programs, and many commentators believe this had influenced a predominantly black Birmingham jury that might otherwise have been more receptive to the prosecution's case. The acquittal was not the end of Scrushy's legal difficulties, and in 2006 he was convicted on separate charges, bribery and conspiracy, relating to payments he had allegedly made to the former governor of Alabama Donald Siegelman in exchange for a seat on a state healthcare regulatory board, and Scrushy was sentenced to approximately 7 years in federal prison and served approximately 5 years before his release. HealthSouth itself survived the fraud and underwent a significant restructuring, changing its name to Encompass Health in 2018 and continuing to operate as a major provider of rehabilitation healthcare services. And the company's survival was testament to the fact that whatever the fraud had done to the financial statements, the underlying business had real value and real patience and real facilities that continued to operate through the scandal. So what is the real lesson of HealthSouth? And the lesson is about the institutionalization of fraud, and what makes HealthSouth distinctive is not the scale of the fraud, which while significant was not the largest of its era, but the degree to which a systematic accounting fraud was normalized across the finance function of a large public company. 5 successive CFOs participated, finance teams below them participated, and the fraud persisted for nearly 15 years, and this suggests that once a fraud of this kind becomes established in a company's culture, it develops a self-perpetuating logic. Each person who joins the finance function is confronted with a system that already operates this way, and the choice to resist is presented not as the normal ethical choice but as an extraordinary act of disruption that would have immediate career consequences. And this is how large-scale accounting fraud survives, not through the brilliance of its architects but through the normalization of dishonesty that follows the initial decision to deceive. That is the capital case. Subscribe to the capital case because the next case is already waiting.